Hi folks, it's Adrian CryptoBirb speaking. Welcome to today's Friday webinar. It's the day before Christmas. It's the day that starts something that I know as a Santa Claus rally that ever since 1950 has actually always brought positive returns on average, despite some singular cases, exceptional cases when they turned negative. Well, will it be any different? How will Bitcoin react? And if it's there actually more downside, we're going to have a look at the intermarket technical analysis and multiple technical chart outlooks for Bitcoin and more. If you're ready to hear this and more, make sure to stay tuned. We are going there right in a second. Hi folks, it's Adrian again, CryptoBirb. Nice seeing you, nice meeting you guys. I can see it here in the comments. Coming up, Harkrishan, if I'm sorry if I'm wrong about pronouncing that. It's very nice to welcome you guys in the chats and a couple of other good lads who are also tuning in on Twitter across our Twitter accounts, on the Burbness, on my personal Twitter account at crypto_burb, on our Twitter, on our Twitch. And well, this is definitely a good reason, to welcome you guys, because this is the last day before Christmas. So technically, we're almost kind of like in this Christmas. We're in this Christmas kind of like a merit Christmas theme, for the markets, and many markets are actually reacting somewhat positively. And this positive reaction often comes to the markets as something that we know under the name of Santa Claus rally. So we're going to study through this and a couple of other ideas throughout this entire session. If you guys have any questions that you want me to answer, Merry Christmas to you, Plan Zero, and Merry Christmas to you guys, everybody. All the best love, and God bless you all who are always positive, and that's really amazing. And drop your questions if you have any, and I'll try to answer them. And let's make sure this Christmas time is actually also peaceful and great for everybody to get some final values. Let's have a look at what's cooking. So first of all, we are talking about something that I named as, not named, but something that I refer to, and the other traders refer to as the Santa Claus rally. Well, Santa Claus rally is the last 5 days of a year that basically starts, the overall last 5 days, this is 5 days of a year, and also 2 days of the following year that starts, right? So that we have a kind of like a limited period, some couple of days in a sequence that typically return and behave positively. This is very interesting because, well, there are some patterns, and there are patterns which are not existent, as in there are patterns and there are no patterns, if you will, right? There are situations where certain patterns, as in certain repetitive formulas, some specific behavioral actions, tend to repeat, and the times when those actually do not appear at all, as in more chaos, more, overall entropic environment in the web. There's a lot of entropy, there's a lot of chaos, there's very little consistency and no patterns whatsoever. So here we're talking about an overall case of a Santa Claus seasonal pattern. Well, this is not some sort of like a triangular shape. It's not the type of a pattern that you can actually just put it in the chart and then just put it in some nice triangle, or get it wrapped in some overall shape of head and shoulders. That's not this type of a pattern that we're talking about. In fact, instead, we're talking about a seasonal pattern, which means that it comes every now and then, every specific season. We know that on average, the markets tend to be more positive than not towards the end of the year, as people write off the taxes, and then also, there is some overall, Christmas time, of course, for many people who are celebrating that. So people tend to get to love presents, and so that the others can buy those presents. And if they buy, then, well, typically the production or the manufacturers, earn more money, so they increase the production, and typically kind of like increases the earnings, the boost, and an overall stock market reaction in other markets tend to get more bullish than bearish towards the end of the year. That's a typical seasonal pattern. However, it's often followed by an overall decreasing performance in February, that tends to be more negative on average, and so on and so forth. So there is an overall, quarter 3, which is some sort of like a summer type, and lots of hot weather encourages lots of people, to take vacations, take time off, which typically brings less volume and less encouragement for the bullish price action to develop, and so on and so forth. So we know that such patterns, on certain occasions they do appear, and on the other occasions they do not appear. So if we study deeper, on the Santa Claus rally, then since 1950, which is 72 years ago overall, this pattern brings positive average returns. It means that if you if you had invested for the past 72 years, and if you bought every time this Santa Claus rally pattern, would be assumed to exist, then it means that you would be on average profitable. Then this is something, right? If it had no role, if it had no kind of like, no technical formula, no technical power force to it, then it would be chaotic. It would return at best 0 or return, negative returns basically. So in fact, the actual case that it provides you with positive returns, positive outlooks out of your investments, this means something. This is already something. And this is the last trading day before Christmas for today, yeah? And today's historical probabilities of the past 25 years tell you that the Dow Jones on average has 42, almost 43% of chances closing higher than it opened, which means that 43% of the times over the past 21 years, Dow Jones closed bullish on that day. NASDAQ, on the other hand, closed almost 62% bullish. Yeah, so 62% of the candles of the daily candles for 23rd of December closed bullish higher than they opened. So again, this does not necessarily guarantee anything specific for you, but well, it means that if there's a certain pattern that holds over the years and it tends to gain you more bullish advantage than bearish, let's say it's not a 50-50 kind of like, random split, but it's more leaning, and leaning towards a bullish resolution, then the question appears and should appear in your head whether or not it's worth it to trade counter it. Yeah, so seasonal patterns can really be this very, very good risk control support aid to you. Yeah, Merry Christmas, by the way, Jide Cole. I love this. Great name. And it doesn't really, again, guarantee anything specific, and nothing in technical analysis can guarantee you any specific returns in future. The fact that the past returns or the past patterns looked in a way or one way or another, it doesn't translate directly in the pattern repeating infinitely forever the same way, because of course each and every single second that the time passes, we are looking at different set of data, different reasons for people to buy or sell, so it's never exactly the same. However, the market mechanisms driven by this overall expectations, traders expecting certain outcomes in future. Well, if they're expecting the future to be bullish, they would buy. If they expect the future to be bearish, they would sell to it. So this often as a self-fulfilling prophecy kind of like also empowers this Santa Claus rally a little bit, because people read and see that there are certain statistics confirming that, they would often lean more towards believing it much more likely than not. So again, it's not something that you should do blindly. It's just a little bit of a trick, a little bit of a present that the market gives to you. Basically, the market says to you, hey, look at it. This is something cool. Like, I've got this Santa Claus rally. This is something cool. Have a look. Maybe it will help you. So that's the way you should kind of like look at it. And you can tell that a seasonal average, as you kind of like break down the months, break down the years by the months, and then look and observing how this typical average seasonal kind of like curve just improves, you can tell that this rally, like I said, enters the steepest point towards the end of the year, and most of the time, or at least half of December, tends to be positive. So the first, historically over the past, pay attention, 125 years. This chart represents 125 years of data for Dow Jones. So this refers that over the past 125 years, an overall bearish pattern has developed, on the first half of December, while it rallied off the lows typically towards the end of the year. And this is what marks this final right tail of the curve, this Santa Claus rally. So again, is this something that you should blindly trust? I wouldn't say so. Just for the confirmation. Of course, this is the curve that I was talking about. Now I was talking about the seasonal average, and the seasonal average basically tells you, breaks down, like I said, this month, year bar months, and typically over the 125 years of the data, for Dow Jones average, the first half of December tends to be, bearish. The first, the end, the 3/4 or 4/5 of the entire, October tends to be bearish as it kind of like enters October, and starts, leaning down south on average on the past 125 years. And it often kind of like marks the bottom for the stocks in October, last week of October. So let's now have a look where the markets bottomed this year. This is Dow Jones Industrial Average and Dow Jones Transportation, and have a look. October's bottom. So that's it. Yeah, it doesn't promise anything, as in, oh yeah, like invest for the rest of your life, put all your money, all your savings in this on leverage, and you're always going to have money. That's not what it says. It says that in fact, on average, if the stock market and other markets bottom, it tends to be October, right? Tends to be this last weeks of October. And well, this time it happened to confirm this kind of like statistic. So we just adds a little bit of more credibility and a little bit of more reliability to such a pattern. So it's a cool trick. It's a cool thing to know for you as a trader, because like I said, if you have strong seasonal favors, and you know that, let's say, just like on the next kind of like 27th of December, you got the records of Dow Jones being 70%, over 70% time of the times bullish, then this should give you a question like, if I only have 30% of chances of being right if I shorted historically, then is this really a good bet? Well, typically for gambling, if you will, you would love to have at least 51% odds, basically speaking, in your favors. So if you have it, not 51, but actually, 29% here, yeah, so 28.6% of the chances of being right as a bear for Dow Jones on the Tuesday that the market opens after Christmas, then doesn't make sense shorting to you? Perhaps it does, right? Perhaps you're going to win this. I'm just saying that historical records tell you that 71.5%, almost 71% of the time, the market turned bullish and closed higher than it opened, which means that if you bought on that day, 27th, every year for the past 21 years in this very context, the seasonality market probabilities, then on average you will be positive. You would earn money. So that's what it says, and that's why it's very important to keep the track of the seasonality and other patterns like that. So if you go and have a look in actual, just steep records for the averages, like I said, for the past couple of days, of course, we were looking at this overall distribution. It wasn't necessarily too positive for the markets. The S&P 500 rejected a 200-day curve, the bear market resistance, if you will, which hasn't flattened out just yet. So it tells me that the large cap stocks are still moving down, maybe a little bit slower than in the early months of the year, but it's still kind of like just not the most powerful action. However, if you compare that with the Dow Jones Industrials, that's the same average, 200-day average. It's already flattened, and Dow Jones had already broken up steeply and strongly to the upside. Right now, having the complete pullback, mean reversion to the 200-day. So it's kind of like the S&P 500 is here on the same chart versus the same average. Is somewhere over here after rejecting this 200-day and kind of like pulling back, and we are talking about Dow Jones being here. So it technically gives you a little bit of advantage that the industrial average, which is a little bit similar to large caps, however it's not the same, of course. This tells you that there is some hope for the market. Not everything is lost. That despite the overall macroeconomic indicators are fully recessive on the leading indicators such as interest rate spreads, or this new housing permits or slowing down. This overall perhaps labor market is slowly kind of like diverging. New jobs are created, but they are not covered. So the wages eventually will have to increase. So this kind of like puts itself into recession. So we are likely looking at the leadership of the stock market by 6 to 9 months over the business cycle. So if we know, or if we assume, and it seems this way, that the market has in fact bottomed in October, then on average you would have 6 to 9 months until the economy exits the recession. Yeah, so we hope, let's assume we already got this market bottom in October. So what it tells me is that we would probably end the recession at, end the little of the recession somewhere in the quarter 1 or quarter 2, most likely quarter 2. So it's like April, July, something like this. So it makes sense to expect still not good environment for business, not good environment for stocks, maybe a little bit more sideways. Typically, again, this is not something that encourages the full-blown out bull market. In fact, it means and encourages more a little bit of a sideways environment. Even if there is a bull market, it doesn't interrupt the bull markets per se. It can, like stocks, and look as if they already are in the new bull market, or at least escape the old bear market. Then it still tells you that the full bulls cannot be unleashed as long as the economy is kind of like moving counter the stock cycle. So only if they move in tandem, only if the economy favors and supports the stock market, then we have those full powerful rallies, those full pumps on cryptos as well, because cryptos are not, and Bitcoin are not trading in vacuum. They are all interconnected and interrelated to the other markets. That's exactly the reason why I'm discussing and always starting with analyzing this aspect. Let's go further. So like I said, we know that the 125 years of data for the Dow Jones Industrial Average shows you the stronger end of a year. Typically, this is the trended data, so it ignores the trend. Kind of like shows you this favorable conditions for the market to rise on the 125 years on average, with December's being one of the best months of the year, again on average. Industrials are also dependent and interdependent on the energy sector. So the energy sectors here, per the XLE, which is the overall sector ETF for the energy stocks. So this energy stocks kind of like chart tells you that, of course, it's a very strong, well-defined bull market for the 200 days average, kind of like continues to ascend very strongly, very decisively. This is a strong consensus from the market that we're going up. However, there's been definitely a lot of slowdown. You can tell that this massive symmetrical triangle kind of like broke out to the upside. It offered somewhat of a good, I should say, rally of 78, 75 regions all the way to 94, 93, 74. So it's a strong pattern, strong rally. However, there are local signs of distribution. If you kind of like zoom it in, then you are looking at this pattern that I was referring to and warning about, this kind of like a reversal, this rounded reversal, this saucer, cap pattern, whatever you name that, doesn't matter. What matters is that it had a couple of those small, small gaps, basically, small exhaustion gaps. And I'm talking about gap like this one, like this one. I hope you can see this. Those tiny little gaps, that are there. Those typically, when they kind of like appear and close on the next day or on the same week, this tells you that the market is already exhausted, that the volatility is still big, but it's kind of like exhausted in terms of the momentum. But this is where the market turns more likely than not. Here we're looking, in fact, at the following pattern after the breakdown. We're looking at the set of rejections at the resistance, at the newly created resistance out of the previously broken support. So it tells me that, unless we really break it, nice and sharply to the upside over 94 and kind of like unleash the full bulls to continue, we are overall in the bull market. So the bulls are more likely to keep the maintain the advantage. Then I would argue then otherwise, if we don't have this force and then this overall reason to continue upwards, then this may mean that the market is going to pull back and complete the mean reversion towards 78. And this technically could be bullish. Paradoxically, not so much for the energy market, but it could be bullish for other markets, for stocks and for cryptos. Why is that? I'm going to tell you that right in a second, but let me say back all the happy holidays to you guys. Crypto 101, love the name. All the blessings. God bless you all, guys, and I hope really Jesus blesses you all and other families, for this beautiful Christmas time, and that you all stay positive and that you all have beautiful end of the year as well. Hi, Burp. All happy holiday season. May have to wait longer for the bull season. We'll see, Eddie. Eddie Katz is commenting. Love the name, Eddie. Great name. Thanks for great comment. I do think we wait for this full blown out, season for the bulls, kind of like that. You would buy anything and it just rallies whatever you do, no matter what you do. So we are probably going to wait for it. However, the stock market has likely already turned. So it's positive. We are likely yet to feel the recession, hence the 50 basis point rate hike by Jay Powell recently on the latest FOMC on December 14th. And well, they said that the full recessive environment, the full impact and effect of imposing those rate hikes, is yet to be felt, which what makes me feel exactly that aligns with this very deep interest rate spreads. This is something I can already show it to you. Very deep interest rate spreads. This is not something that is necessarily very, very positive, I should say. This is something that you should be aware of. That it's a typical recessive indicator and a leading indicator. Such an interest rate spread, can take you with the conclusions that we are technically, or actually economically, from the macro financial perspective, we are in the worst and the deepest yield curve inversion, the biggest kind of like shatter, the worst economic conditions, if you will, leading conditions towards a leading sharp recession potentially. Ever since 1980, ever since 1980s. So the last time we saw such a deep yield curve inversion, which means that the economy was kind of like in a shattered, not in the inverse, mode, in a bad condition, then the last time it was like that, it was actually 1980s. It was 40 years ago. So it's not something that you should be celebrating. It's something that you should be definitely understanding, that the economy is telling you that, okay, that the regular relationships between the securities, between the bond, of course, and payoffs and the overall yields, are a little bit inverted, where the 2 years are actually paying you off much more, and better yield than the 10 years, which is inverse relationship. Is technically when you lend money for longer, it should pay you more naturally. So it's telling you that this rotated demand kind of like a model is really what the investor is telling you, with that it's they're not expecting the future to be bright for the next 6 to 9 months. That's what it says. So exactly knowing that, again, the stocks market tend to lead the economy, and we've seen the bottom reversal in October so far, but it seems to be strengthened every day this way, unless again some war escalation occurs. Then I would argue we have pretty good odds, technically, chart-wise, to see the end of a recession or the bottom of the economy when it starts expanding back again in, well, Q2, which is April through July. Let's see how it goes. And guys, how does it all impact cryptocurrencies? Because that's exactly the point. Well, we're still talking about strong dollar, right? So strong dollar is not good for Bitcoin. It's in fact bad for Bitcoin. It's bad for anything that is priced and evaluated in dollar. When you have a stock or gold priced versus dollar, or priced, evaluated, devaluated in, denominated in dollar, in American dollar, then if the dollar increases its strength relatively against other, basket of other currencies, then this is not the most favorable situation. It often comes, of course, with the interest rate, because interest rate hikes, because it decreases the supply of M2 of money, to of the second aggregate of money, in the circulation, which again overall increases this scarcity, if you will, and boosts the prices. So this is not the most favorable situation for all the other risk assets and stocks. So strong energy prices are as well not too much positive. So on average, again, moving sharply and strongly to the upside, this is telling you that on average it's increasing. So the cost of your energy are increasing on the long, or in the bull market, or in the rising. Yeah. So this means that you are right now set to pay more and more for your energy, which kind of like eventually withdraws money out of your pocket, right? It takes money out of your pocket, and it actually just disables you, and takes this option from you, this opportunity to invest. For that, the markets are emptier. There's much more of an echo chamber, less liquidity, and less liquidity means less buyers, fewer buyers, and fewer buyers mean that the prices are less likely to go up easily. So for all of that, if you go and actually just study Bitcoin charts, then we can acknowledge for a couple of very interesting points. So first of all, a strong correlation coefficient, which kind of like turned which was a couple of weeks ago, and the very strong inverse relationship with stocks, which means that Bitcoin and stocks traded differently. Right now it's kind of like inverting and getting back to this overall weak correlation. So Bitcoin is weakly correlated right now, is almost not correlated, I should say, with stocks. So this is what people would probably recall or frame as this quote unquote decoupling. I'm not a big fan of this word, but decoupling would mean complete detachment of relationships between stocks and Bitcoin. It's not possible. It's not good or bad either. It's momentary. It's kind of like the only time you get this so-called decoupling is this single time that Bitcoin is actually at the point of zero correlation to S&P 500. And it's well, it means that at that time, for a very short period of time, for like a week or two, only then it can be a good means of diversification against the volatility from stocks. But other than this, it's not a good move. It's not a good move. So most of the year so far, we've been, of course, maintaining this strong positive correlation. Of course, FTX, inverted everything, and we got this strong context where stocks were moving up, but Bitcoin was basically sinking. This is the breakdown, of course, that took us, to 15,500s out of or outside of this descending triangle. So technical target for this descending triangle stretching between 17,500 lows of July after Terra crash and this overall $25,000 resistance, which was rejected. This takes you with the price objective towards $12,000. $12,000. However, depending on how you kind of calculate, I would argue that you should be ready that if the prices continue to move lower, and if the prices refuse to go up sharply and soon, then the miners are at risk. The miners who mine Bitcoin, are expecting, are really meeting and experiencing lots of supply pressures because they're running unprofitable businesses. And it means how long can you run on the reserves until the reserves run out or until the reserves just expire. So it's definitely not helping to the miners, so that the Bitcoin prices are low, and the lower they stay, for the longer they stay low, the bigger the chances that the miners will have to drop off and capitulate. And if that happens, then we know, well, it's not a surprise that technical traders would have their support levels or the stop losses at the lowest point of the chart, which for the year is 15,500. So a layer of stop losses is likely hiding there. So imagine the prices just go momentarily below this level. This may trigger the stop losses, which means that if traders are forced to sell lower to compensate and take their losses, and this kind of like pulls the prices lower, which adds even more supply pressures, even more pressures, this discomfort, this stress to the miners. And as a result, this may cause additional, again, tensions and forcing them to sell, which additionally empowers this kind of like, self-fulfilling and self-promoting feedback loop where when one encourages another to sell. So the traders capitulate, then miners capitulate. The more miners capitulate, the more traders capitulate. The more traders capitulate, the bigger the disparity between the mining costs and the price of Bitcoin, and the more miners capitulate. So it may happen than this magical target. People love certain magical round numbers, such as $10,000. So I would argue that with $12,000 as a technical objective for the breakdown of the pattern that already happened, then many traders will look in this direction. And $10,000 is the sweet spot round number that people would love to frame their minds on, would love to anchor on. It's just nice a number on the chart. And because of that, it works. So if enough people look at the same target in the same direction, it may happen that they're going to wait and not buy Bitcoin until the prices just reach this low, which automatically is going to make this pattern fulfill this way. So I would argue that, if we are to answer if there is more downside for Bitcoin, I would argue that it's not looking bullish. It's not looking bullish. I would really love to say that it's bullish, but it's not. It's in fact looking much more bearish than bullish. You're not looking at any short-term reversal patterns. You're looking, in fact, at the daily chart, which continues to move down on average ever since peaking out in 2021 November 7th. We've moved down by 77% in total measure from the peak to the trough. And well, we are definitely not slowing down on the decrease or on the descent of the 200-day mean. So this 200-day average tells you this is 200-day average is a bear market resistance, is the bear market trend. If it's a bull market and it's increasing and it's a bull market trend. However, right now it's moving down on average, which means that market is in the bear market shift. It's in a bear market mode. So it's not going to escape this bear market mode until it starts reversing and showing strength against this bear market trend. I hope it makes sense from the technical point of view, of course. So right now we're looking at a little bit of, again, this first of all, fake out at the bottom, an attempt, and another fake at the FOMC announcement at the very peak. And all I know is that the failed patterns tend to perform better in the opposite direction. So if you see a pattern that trades sideways, this is the very case that I'm explaining, trades sideways, and then it kind of like tilts, outside for a moment, but it kind of like hides back and fails to stay outside, for longer, then it invalidates the breakout, and it has basically makes all the losing traders to cover and close on the losing positions if they bought on the buy trigger, on the break under the resistance, and empowers the sellers. So this typically, again, just takes the stop losses off and out, and empowers the further sell-off. And overall, failed patterns tend to perform better in the opposite direction because of that. So I would argue that despite we had a little bit of a promising breakout towards 18,300, however, the FOMC by 50 basis point rate hike brought the markets down all across the board, stocks and cryptos. So we are more likely than not looking down. The bear market is moving down. The bear market curve is still valid. It's looking strong and defined and decisive. It's not looking anywhere near ready to reverse. And for comparison, this is the same. This is the same bull market. This is the same bear market trend or trend overall 200-day trend for the Dow Jones Industrials. So in this case, the market is flat already. So it tells you that the Dow Jones Industrials is looking way better than the Bitcoin is. So Dow Jones stocks most likely have already escaped the bear market, but Bitcoin is still in its own bear market. Of course, mainly because of the FTX collapse, which triggered a lot of sell-off and panic. So all those things concerned, the bear market trend is down. Local trend on this medium time frame kind of like perspective is also looking down, following the breakdown of a strong support at 17,500. We cannot and fail to break above it back again. Failed pattern on top. So we were looking at bearish setups all across the time frames. Bearish setup on the long-term time frame, on the short-term time frame, and on the medium-term time frame. It doesn't mean it cannot reverse at any time soon, of course, but it does mean and tell you that technically the chart is telling you that Bitcoin is more likely looking at more downside. And if there is more downside, in fact, I wish I had crystal ball, but if there is more downside to come, in fact, then it may well come, somewhere in January, February, which is a typical more bearish kind of like seasonal pattern for Bitcoin as well. That's a story for another topic and for another discussion. And guys, I do hope you enjoyed this video. If you did, make sure you hit the subscribe button, smash the likes, hit the notification bells on so that you stay tuned on the updates. And before I go, I've got a very exciting news and a little bit of a promise, a pinky promise to you, because on 27th, which is also another reason why I mentioned Tuesday with the statistics of being a strongly bullish day, after Christmas, on Tuesday, next Tuesday, right after Christmas, we are celebrating huge anniversary, the 5th anniversary, the fifth birthday of my company, of the Birb Nest, of this very beautiful community you guys are part of. So congratulations to you. You are belonging really to this amazing home and family, really that the Birb Nest has united tens of thousands and even more traders, professionals. Right now, as the only CMT from my country, as the only charter market technician, professionally audited and accredited market technician, technical analyst from my home country, I'm happy to invite you to celebrate with us, because 27th of December is marking the 5th birthday of the Birb Nest. And you guys are part of it, so let's celebrate together. And for that, this year, I'm going to celebrate it a little bit differently, a little bit more differently than in the past years, because I'm going to release something special. Something special as in we're working a release of a special thing, special value to you. And it's going to come to you for free. And if you guys want to really learn how to stop losing, how to, keep, basically away and go away from getting wrecked completely and blowing up all your accounts, and at the same time, get inspired to learn to behind the closed doors and improve all your tradings all across the board and really win towards your success, uh, then you're going to be given the chance on 27th of December to do it for free with our premium package that normally costs a lot of money monthly, and you're going to be able to get month, 4 months, or even a year of this package for free. No costs, no charge, nothing, zilch, no, nothing. Zero. And that's it, guys. And don't take only my words for it. There are plenty of words that many of our amazing traders shared, and that they're grateful for it. And all you have to do is well, keep your eyes open, because on my Twitter, on YouTube, and on my pinned tweet on Twitter, if you go to my Twitter, I've got this pinned tweet, and to say yes that you are interested, just press like and retweet and comment yes, so that I know and count you in, guys, and so that you can celebrate in a special way by getting insane value that typically costs hundreds of thousands of dollars, hundreds and thousands of dollars yearly. You're going to get it all for free, and you're going to get charged nothing. And that's my best Christmas gift, guys. I cannot give you money. I cannot give you, charity. I cannot give you guarantees that you're going to be millionaires tomorrow. That technical analysis or investments don't work like magic. It doesn't just, make it enough that you say, I want to be a billionaire tomorrow. So, and then I'm boom, snap of a finger, and I'm expecting $1 billion back, tomorrow right in front of my door. It doesn't work like that. It takes years, it takes dedication, it takes all the right tools and accredited guidance. And this is exactly what you're going to get. And I'm going to get you that free of any charge. If that doesn't sound exciting to you guys for the 5th anniversary of the Burbness beautiful community, then I don't know what will. God bless you all, guys. Thank you for participating and joining for today's stream. I hope you have beautiful time with your families. You guys are doing great job. You right now give yourself the chance to become the winners of the next bull run. The bear market has been really tough. Tons of people, 99% of the market had already dropped out. Huge companies blowing up, exchanges going insolvent. It's crazy. You are still here. Shout out to you. Congratulations. Give yourself a round of applause, everybody. You deserve it. You're doing a great job. Keep it up. And I see you guys after Christmas. God bless you all. Merry Christmas.